Last week, interest rates remained steady amidst a whirlwind of market-moving events. From Fed speculations to economic indicators, there's been a lot to digest. Let's dive into this week's mortgage market update. The Fed has been hinting at potential rate cuts with expectations pointing towards June for the first move. This anticipation has nudged the 10-year note yield up to 4.3%, pushing 30-year fixed-rate mortgages back above 7%. The Fed's favorite gauge of inflation, the Core PCE Index, met expectations at 2.8% year over year, easing concerns of overheating. The Fed is looking for a sustained move towards 2% before considering rate cuts, emphasizing the importance of moderation. Treasury's massive bond sales last week sent ripples through the market, weighing down bond prices and stalling rate improvement. The Treasury Department unloaded a record amount of 2- and 5-year notes, a total of $127 billion sold within a couple of hours, and the bond market just didn't like it. Deficits remain a concern with ongoing scrutiny on Treasury auctions and market appetite. Durable goods orders, items with a 3-year or greater lifespan, fell below expectations, signaling possible consumer caution. As the backbone of economic growth, any contraction in consumer spending raises recessionary red flags. In addition to all the news, we must watch key technical levels, and the key level in the Treasury market is 4.32% on the 10-year note yield. We have not seen a close significantly above this in 2024, so we need to keep an eye on that. Its resilience could dictate rate movements, with rates poised to climb if breached. Uncertainty continues to loom over markets as Fed officials remain noncommittal on rate cut timing, indicative of the Fed's overall stance. Fed Governor Michelle Bowman stated this last week that, quote, should the incoming data continue to indicate that inflation is moving sustainably toward our 2% goal, it will eventually become appropriate to gradually lower our policy rate to prevent monetary policy from becoming overly restrictive. In my view, we are not yet at that point, unquote. Now, note the word gradually. Nothing is going to happen quickly unless they wind up breaking something in the economy along the way. Now, looking ahead, this week all eyes are on jobs data with multiple labor market readings scheduled, including the all-important jobs report for the month of February out this Friday morning. The numbers could sway the Fed on rate cut. Currently, expectations are for the unemployment rate to remain steady at 3.7%, while 188,000 jobs to be created in the month. If these numbers are strong, it will embolden the Fed to hold off on cutting rates. Amidst the noise, the bond market's been resilient, but the next move for the Fed hinges on inflation and economic indicators. Stay tuned for future updates as we navigate these dynamic markets together. Now, as we wrap things up here, here's a peek at a 12-month chart of the 30-year fixed-rate mortgage, just as a perspective. Feel free to hit pause for the details. And as always, thanks for hanging with me for this week's mortgage market update. Be sure to like, comment, and share. And if you need personalized mortgage advice, I'm always here to help. Reach out to me today. I look forward to funding your future, and have a great week.